In this video, I am going to discuss about liquidity ratios. Liquidity ratios are financial metrics used to assess a company's ability to meet its short-term obligations. These ratios measure a company's ability to convert its assets into cash quickly to pay its debts. There are two types of liquidity ratios, current ratio and quick ratio. Now let's discuss about each of these ratios one by one. Current ratio. This ratio compares a company's current assets to its current liabilities. A higher current ratio indicates that the company has sufficient assets to pay off its short-term debts. Generally, a current ratio of 1.5 or higher is considered to be good. This ratio value is not a specific value. Generally, if the current ratio is 1.5 or higher, it is considered to be good. Depending on the industry, this ratio can be changed. This is how we can calculate the current ratio. Current assets divided by the current liabilities. These are the most common current assets in an organization. Cash and cash equivalents, short-term investments, accounts receivable, inventory, prepaid expenses. These are the most common current liabilities in an organization. Accounts payable, short-term loans, accrued expenses, income tax payable, unearned revenue. Current ratio is not a percentage value, it is a decimal value. Now let's do this example and calculate the current ratio. They have given us the cash and cash equivalents, short-term investments, accrued expenses, unearned revenue, accounts receivable, inventory, prepaid expenses, accounts payable, short-term loans. First of all, what we have to do is we have to identify the current assets and the current liabilities separately. Current ratio is equal to current assets divided by current liabilities. Now let's identify the current liabilities and current assets. Cash and cash equivalents. This is a current asset. So 50,000. Short-term investments. This is also a current asset. 8,000. Accrued expenses. These are the expenses that the business was not able to pay. This is a current liability. 3,000. Unearned revenue. These are the revenues that are received from the customers in advance. So this is a liability. Accounts receivable. These are the revenue that the customers should have paid to the business, but they still haven't paid it yet. So this will be a current asset. Inventory. This is a current asset. Prepaid expenses. These are the expenses paid in advance. So this will be also a current asset to the company. Accounts payable. These are the expenses that the company has to pay to their suppliers. So this will be a current liability. Finally, the short-term loans. This is a form of current liability. So the current ratio is equal to 1.35. So this is the current ratio for the company. This means the company has 1.35 times of current assets when it compares to the current liabilities. Now let's discuss about the quick ratio. This is also known as the acid test ratio. This ratio compares a company's quick assets such as cash, short-term investments and account receivable to its current liabilities. It is a more stringent measure of liquidity than the current ratio, as it excludes inventory. This is important. In the quick ratio, we exclude the inventory. The only difference between the quick ratio and the current ratio is that we do not consider the inventory. We exclude the inventory. Inventory is excluded from the quick ratio calculation because it is considered to be less liquid than other current assets. A quick ratio of 1 or higher is generally considered to be sufficient for a business. This means that the company has enough quick assets to cover its current liabilities. A quick ratio of 1 or higher is generally considered to be sufficient for a business. This means that the company has enough quick assets to cover its current liabilities. This is how we can calculate the quick ratio. Current assets minus inventory divided by current liabilities. The only difference between the current ratio and the quick ratio is that we exclude the inventory from the current assets in the quick ratio. These are the current assets as before. We do not consider the inventory under current assets, and these are the current liabilities as before. If the question is giving you the total current asset amount, you have to deduct the inventory amount. If they are giving the current assets one by one, you just have to calculate the current assets without the inventory. Quick ratio is not a percentage value, it is a decimal value. Now let's do this example. This is the same example as before. Now we have to calculate the quick ratio. So the inventory level here is not relevant to the calculation because we do not consider the inventory in quick ratio calculation. We can simply ignore the inventory value. So this is equal to, this is the cash and cash equivalents, and this is the short term investments, this is the account receivable, and this is the prepaid expenses. In the denominator, this is the accrued expenses, this is the unearned revenue, and this is the accounts payable, and finally this is the short term loans. In this calculation, we did not consider the inventory value. So the quick ratio is equal to 1.14. Thank you for watching. See you in the next video.